Hi, I'm James Robinson, and this is my stock pick of the week. Today we're going to take a closer look at the operations for Electronic Arts, symbol EA. But before we do that, here's a look at a map of the United States of where my known subscribers are. And I think this is cool. I always like to keep track of where people are following me from. I'm now, since I posted my last video, I've added Brazil and Australia to the list, as well as a couple people in America. So I'm now on 5 continents, which is pretty exciting. So if you could, please just put down in the comments below what city and country you're from so I can put your dot on the map. Thanks. This chart looks at the gross margins for a company. I think the gross margins are extremely important. I look at gross margins as the same thing as altitude for a plane. If you have a problem with your plane at 500 feet and your engine goes out, you're going to land immediately. If you're at 12,000 or 15,000 or 30,000 feet and you have a problem with your plane, you have time to work through the problem, to sort it out, to find a runway, to communicate with the ground, to make sure there's emergency personnel there. So gross margins to me give you that buffer zone. Things can go a little bit wrong and it can still be okay. If your company has 10% gross margins, for example, and you have a 3% reduction in sales, that's catastrophic. For a company that has an 80% gross margin, a 3% reduction in sales is virtually irrelevant. So I look for that. I actually kind of look for companies that have gross margins that are above 40%. That's where I really like companies to be. This company's gross margins are over 80%, which is spectacular. I mean, really, really good. There's a bunch of reasons for that. First of all, they're a software company, so they don't have a lot of manufacturing costs. They don't have a lot of inventory costs, as we'll talk about. But also they have licensing situations where they know that they're going to make money from FIFA soccer. They know they're going to make money from Madden, because every year they put out the exact same product, slight enhancements, but people have to buy it because they want the latest rosters, the latest players on the teams, plus whatever upgrades are there. So this company is uniquely positioned for that. Also, I want to stress that I'm buying this company because I think it's very well positioned to survive coronavirus. I think that people can't go to Disney, for example, because the parks are closed. There's nothing Disney can do to solve its problems. However, people are going to stay at home and they're going to play video games because they have more time to do it and they have less options. They can't watch sports, so they can play Madden. So I really do think this company is going to do better and better in the next 12 months than it's done in the past. So the earnings for this company have been a pretty mixed bag. We have a situation where the company kind of was growing nicely along until about 2004. Then in 2004, it started a very long drop of about 7 years. And then since then, it's managed to right the ship and get better and better. And then for the last 4 years, 5 years really, the company's stock has been pretty flat. So it's kind of an interesting company from that standpoint. I'm not looking at this as a growth company. I'm not looking at this as necessarily as a company that's going to double and double and double its earnings right now. I think it's a company that's going to be a solid producer, a solid earner. And again, I think that it's going to have some benefit as a result of this coronavirus. So it's also a company that I think is very safe. I think there's very little downside for this company. And when a lot of companies that I'm looking at may have significant downsides in their earning capabilities, if I'm going to be investing in a company, at the very least I want to start with, do no harm to my portfolio. And I think this company does fall in that line. Almost as important as gross margins, maybe more important than gross margins, is net earnings as a percentage of revenue. What I like to see here is that the company is, in the neighborhood of 20% of the money the company earns in gross profits make it to the bottom line. And this company's achieved that for the last 5 years pretty consistently. So that means this company is pretty well run, doing a pretty good job of returning money to the shareholders. And so I'm very comfortable with that. You can see that the revenues have managed to grow really every year since 2000, and that the net earnings have been pretty flat for the last few years, but pretty solid as well. The thing that's disappointing is that you'll see that the earnings per share diluted didn't change very much, which indicates the company's not buying back a lot of shares. You'd like to see a company that's earning, in the neighborhood of $1 billion a year, be returning some money to the shareholders. And as we're going to talk about, it doesn't pay dividends. So that's a weakness with this company. I know I sound like I'm downplaying the company a little bit and saying more negative than positive about it. But that's not really the case. I'm just hypercritical, right? I'm looking for companies that do everything right. And when they don't do things right, I like to point it out. The good stuff takes care of itself. And again, we've already talked about the company has good gross margins. It's got solid profits for the better part of a decade. And there's a lot to like. The next three slides look at what I call the taxes, the artificial taxes that every company has to pay in some degree. Those things are selling, general, administrative, plants and equipment, R&D and inventory, as well as interest expense. So to some degree, almost every company has some number of these categories. And to a large extent, the success of a company is based on how well they can manage these costs. And that is really a big job of management, is managing and controlling these costs. You can see, for example, that selling and general administrative has effectively gone down every year for this company since 2010. They're now in the top 25% of companies. I'm very comfortable with that. They've been consistently in the top 25% of companies for the last 5 years. So that's a good sign. Obviously, I'd like to see that number get lower and lower and lower, but I'm okay with where it is. Plants and equipment, the same thing. Plants and equipment's gone down every year since 2010, but that's plants and equipment. So it's gone down every year since 2010, and for the last 4 years, it's been in the top 25% of companies. So again, I'm pretty comfortable with that. One of the things that I really like about software companies in general is the way that they oftentimes have very little inventory costs. This company's effectively had no inventory costs since 2016. That's fantastic. Let me explain why I like that. There's two or three things happening with inventory that can really hurt a company. The first thing is when a company has inventory, they've tied up an amount of cash to make, manufacture, and produce that inventory, oftentimes shipping that inventory to a customer. And then that money sits there until the product sells. And so if you have a lot of inventory, you have a lot of money tied up. But also if you have a lot of inventory and people don't buy your products, then eventually that inventory becomes worthless and you have to write it all off. And so when you have virtually no inventory, you take care of that risk. And that's an important point for this company because one of the things that they produce are these Madden games and the FIFA games and other video games. And at some point, those things all become not worthless, but much less desirable. They get into the discount bin, if you will. And so what I love about this company is that it's got its inventory to the point where it's zero. Now, the way that it's done that is it's selling its games through through online, right? You can download the games instead of buying the games. And that's really made this company that much more attractive because we have absolutely no risk for inventory loss and we have no money tied up in inventory. So I love that quite a bit. R&D, I'm not surprised that the R&D for this company is high. It's in the bottom 10% of companies. That's probably too high. That's R&D to gross profit. But what you have to remember is that the only thing this company really has to offer are new video games. It's their only product. And so they have to spend a lot of money creating and designing those new games. So because everything else is so low, I'll forgive it, but this is a one. Very few of my companies that I buy have very many numbers of ones, and this one does. So on a scale of 1 to 4, I rate this company a 1. It's amongst the worst of the companies that I looked at in terms of converting R&D to gross profit. So this next chart is very interesting. The blue line is interest expense, and you can see that interest expense has gone up since 2000 from about $1 million, from about nothing to in the neighborhood of $45 million. That, of course, is a bummer. We don't ever like to see interest going up. We like to see a company that is paying down its debt. However, when you look at the red line is interest income. That's money that they've put away that's earning them interest, and that number actually supersedes their interest expense. So they are in terms of finances, they're a net profit, which is very, very rare. And so that's a 4 out of 4. That's a really, really high score for that. Also, when you look at the interest expense in the context of operating expense, you can see that they're really not spending very much money on interest expense. The company makes $1 billion a year, and they're spending $45 million on interest expense. And then, of course, they're making more than $90 million in interest income. So, but even the debt they have is minuscule compared to the size of the company, and therefore it's not really worth talking about. Obviously, there's that big dip in 2014, but we ignore that for now. That's kind of a unique circumstance. So that's where we are with interest payments. The company is doing fantastic. They are making more money off their money than they are paying out for the money they borrowed. And I'm not even sure why they don't pay off their interest, the $1 billion of debt. But for some reason, they've chosen not to do that. And I give them a pass because they're making a net profit off their interest expense. So in summary, the biggest thing I love about this company is that I believe it's a company that will, that's very coronavirus resistant. It's going to continue to produce profits, perhaps even increase profits through this period of time because people just have nothing else to do. I look for companies with a gross margin of at least 40%. This company's gross margins have consistently been north of 80%. not much to say there. Our earnings have been pretty flat for the last 5 years, but we're buying the company at 11 times earnings. And so I almost don't mind. I'm happy to buy companies that are paying me an 8 or 9% yield without any growth when there is the prospect for growth, especially when there's very little debt, and I think there's very little downside. Selling and general administrative and plants and equipment are both within the top 25% of companies, so I like that quite a bit. And the company has no inventory, but it does have significantly high cost for R&D, but it does have a net profit of its interest income and expense. So I think it's a very solid company. It's not a lifetime hold kind of company, but it's a company that operates well, and in this environment, I think it's a solid investment. So if you made it this far in the video, I'd like to request that you follow me on Twitter. I don't always manage to make videos the day I buy a stock. I bought this stock back on May 5th, and I'm only just now getting around to making the videos, which is 3 weeks later. But I do always post whenever I buy or sell a stock on my Twitter account. My Twitter account is @RobinsonStocks. So you get real-time information on the trades that I make, updates on when new videos are posted. You'll also have news and thoughts on the market and stocks and other things that I think they're interesting that I occasionally post. And finally, if you like this, please subscribe, like, and comment. Thank you very much for your time.